So in this video, we are going to discuss about accounting conventions and concepts. So first we'll discuss about what is accounting principles. See, accounting principles are the basic norms or and assumptions developed and established as the basis for accounting systems. See, accounts differs from science subjects because in science subjects you have like clear natural laws. Okay, so the gravity is going to be the same across earth, and the weight of air or oxygen is going to be the same, or like the time the sunlight reaching the earth is going to be the same. Okay, so all these things are like very are constant here across the world. It's going to be constant. Okay, so these are like natural laws. Okay, there is no like, it's not going to change from person to person or to country. It won't be like changing a lot. But accounting principles are not like that. Accounting principles are man-made things. Okay, it's a human-made concept. So there is a lot of way in which that one person follows accounts and the other person follows the accounts can be like different. Okay, so you can have your own set of rules, regulations, and you can create an account. I can create my own set of accounts based on my own rules and regulations. Okay, so what happens here is when two set of people are going to follow their own principles and standards, you cannot compare these accounts at all. So the net profit, even though the net profit number can be there, we can't say that both are same. Okay, we cannot say that both are same. So in order to ensure that all accounts are similar throughout the world, okay, so accountants have gathered and they have like created something called as a principles, which are the norms, the rules and assumptions that are like used across the accounting discipline. So why do we have these principles? It provides a basic framework within which the accounting records and accounting reports are to be prepared. Okay, so there is a format in which you have to prepare accounting records and reports. These principles are adopted by the accountants universally, thus providing uniformity and consistency in accounting. So the rules and regulations and the norms, assumptions are consistently followed by all the accountants. So there is going to be a consistency, okay, in the preparation of accounts. Okay, but in reality, what happens is each country adopts its own kind of rules. Okay, so there is like a huge difference between country to country. Okay, so within a country all accountants have to follow the same rules established by that particular country, but from country to country the accounts might be differing. For example, India uses Ind AS. Okay, in US they use US GAAP. Okay, so from country to country the accounting standards are like changing, so comparability and is becoming a huge kind of a problem. But still there are some basic elements which are like adopted across all the countries. Okay, so what is like accepted across all the countries is what we are going to see. Accounting principles are known as generally accepted accounting principles or GAAP. So accounting principles is divided into two parts. One is called as the concepts and the other one is called as conventions. See, concepts are basic assumptions and accounting conventions are guidelines from practice or usage. Okay, so this is what is like followed on a regular basis. Okay, so these are the basic assumptions based on which we are preparing accounts. These are the general guidelines from usage, or in reality what happens, that is what is done. Okay, so we look at both these concepts and conventions. So we'll start with accounting concepts. So this is the list of accounting concepts that are available. We look at each one of this in detail. So first we'll start with business entity concept. This concept implies that a business unit is separate and distinct from the owner or owners, that is the person who supply capital to it. So if you look here, uh, if you take your balance sheet, okay, the on the liability side you have equity. Okay, so liabilities is something that the business owes other people. Okay, so how can the owner money can be said to be owed? Okay, the owner has put in money. Okay, it is his business, But how can we say that the business has to give money to the owner? Because here the concept is that business is a different person and the owner is a different person. Okay, so the owner is giving money to the business. For the business, it has received money from the owner. Okay, so it is a liability. Okay, it is a liability. So this is how we come to the concept of business entity concept. So the concept is like very simple. The business is separate and the owner is separate. Okay, any money that the company gets from the owner is a liability. Okay, based on this concept, accounts are prepared from the point of view of the business and not from the point of view of the owner. Okay, if owner wants to prepare accounts, he has to prepare for himself only. He cannot take the business account. Okay, business account is different. Hence, the business is liable to the owner for the capital contributed by him or her. Okay, so the equity capital provided by the owner is a liability. According to this concept, only business transactions are recorded in the books of accounts. So personal transactions of the owner will not come in the business accounting. Personal transactions of the owner are not recorded, but the transactions with the business, such as capital contributed to the business or cash withdrawn from the business for the personal use, will be recorded in the books of accounts. Okay, so the only the transaction between the business and the owner, that alone will be recorded. Okay, the personal transactions of the owner will not be recorded in the business. Okay, so that's how the concept works. This is a very basic concept. Okay, only when you understand this concept, like many of the transactions, you can understand easily why it is like accounted like that. So the next one is money measurement concept. See, throughout financial statements, okay, throughout your statement of financial position or statement of P&L or statement of cash flow, you will only see one numerical thing. Okay, you will see only one numerical number. The number would be expressed in money. Okay, you will only see dollars or rupees or pound, like that only. You will not see kgs or liters. Okay, or satisfaction rating, nothing like that, because in financial accounting, only money is taken as the measurement here. If something cannot be measured in money, that cannot be recorded here. Okay, only things which can be measured in money can be recorded. So that's about the concept of money measurement. So transactions which do not involve money will not be recorded in the books of accounts. See, for example, working conditions in the workplace, strike by employees, efficiency of management, these things cannot be recorded. Even customer satisfaction, employee satisfaction, efficiency of the machine, nothing can be recorded. Only the financial part can be recorded here. So the next one is called as going concern concept. Okay, see, going concern concept is, it is a basic assumption that business is a going concern and will continue its operations for a foreseeable future. Okay, for example, we have seen what is a current asset, okay, and what's a non-current asset. A current asset is an asset that is going to be converted into cash within a year. A non-current asset is a asset which is going to be used in the business for more than 1 year. Okay, now is have we assumed that the company is going to continue for a long period of time? The answer is yes, we have assumed that. Okay, because we never thought of the company is going to be closed in 6 months, okay, or in 1 year, or in 2 years. Okay, we have assumed that the company will keep on continuing. That is the reason we have a non-current asset. If we expect the company to be closed in 1 year, okay, then all assets are be expected to be sold. Okay, then all assets are current assets. Okay, we are not expecting the company to close in a year. We are expecting it to be running in a year. Sorry, it is to be run beyond many years. Okay, so the assumption is the company is going to be continued for a foreseeable future. Going concern concept influences accounting practices in relation to valuation of asset, liability, depreciation, treatment of outstanding and prepaid expense, accrued and unearned revenues. Okay, so this assumption is so key. Okay, based upon this only, all other accounting items are treated properly. Okay, so even if in terms of current liability and non-current liability, okay, the same concept works. We assume that the company is going to be continued for beyond a lot of years. Okay, so that's why we have the concept of current and non-current. If we expect the entire company should be shut down in 1 year, all liabilities will be current liabilities. Okay, so we are not considering the company to be closed in 1 year and all. So for example, assets are generally valued at historical cost only. Any increase or decrease in the value of asset in the short period is ignored. Okay, so we don't record usually the ups and downs in the asset value. So now we'll move on to the next concept. It's called as cost concept. See, anything that is any asset that is being purchased by the company will be recorded at the acquisition cost. If you buy a machinery, usually it will come with a bill. That bill amount is what is the acquisition cost. Cost of acquisition will be the base for all further accounting. So any depreciation to be made will also be made on cost concept. It does not mean that the asset will always be shown at cost. Okay, it's not. See, the first time recording only will be at cost. Thereafter, it can be revalued as per necessity. It is recorded at cost at the time of its purchase, but it is systematically reduced in its book value by charging depreciation. So that's about the concept of cost concept. So we'll move on to the next very important concept, which is called as dual aspect concept. So here, according to this concept, every transaction or every event has two aspects. Okay, dual effect. For example, when Varun starts a business with a cash of 1 lakh, on the one hand, the business gets a cash of 1 lakh. On the other hand, a liability arises, that is, the business has to pay Varun a sum of 1 lakh. See, the concept works like this. Varun is like giving 1 lakh of cash to the company. Okay, he's giving like 1 lakh of cash to the company as a capital he is giving. So the business has received cash of 1 lakh. Okay, so cash is an asset. So it will record it on the asset side. And as it has to pay to Varun later, okay, that's the company has to pay to Varun later, it is also a liability. Okay, so you have an asset which is cash of 1 lakh and a liability which is a capital of 1 lakh. Put together, the balance sheet will tally. Okay, so every time whatever transaction you do, the balance sheet should tally. That is called as a dual aspect concept. Okay, so if your balance sheet does not tally, then it means that you have not properly done the accounting transactions. Okay, so somewhere accounting transactions have not been recorded properly, or you have not done the financial statements properly. That's why your balance sheet will not tally. Okay, this is the concept that which recognizes the fact that for every debt there is a equal and corresponding credit. Okay, so debit should always equal to a credit. See, what is debt and credit we'll see later. Okay, now we don't need to worry about that. This is the basis of the entire system of double entry bookkeeping. From this concept arises the basic accounting equation, that is capital plus liability equal to asset. Okay, so if you change any of one of this, okay, if you change any one of this, the other one will get affected. Okay, if you're going to increase asset, your capital liability will increase. Okay, so if you decrease your asset, the other will also get correspondingly decreased. Okay, so that is the concept here. So with this we can even create something called as an accounting equation. Okay, see, if you want to increase an asset, okay, if you want to increase the value of an asset, or if you want to show an expense, or if you want to show a loss, you have to debit. Okay, you have to debit it. And if you want to decrease it, you have to credit them. Okay, you have to credit them. On the opposite side, if you want to increase liability, equity, and profit, you have to credit them. And if you want to decrease them, you have to debit them. Okay, so if you can understand one of the rule, if you can understand this rule, okay, exactly opposite is this rule. Exactly opposite is this rule. And when you understand this rule, the exact opposite of this is this rule. Okay, so understand it like that. And when we do journal entry, trial balance, ledger, or financial statements, you will get a better idea of this concept. So the next one is called as periodicity concept. This concept deals with preparing accounts for a particular period. Okay, so we have seen that accounts have to be prepared, but accounts have to be prepared on a particular period basis. Okay, so usually periods are like 1 year or one operating cycle. Okay, so it has to be one operating cycle, can be like 15 months or 18 months also. Okay, so if the company is going to prepare accounts on a regular basis, see, that's how they have to prepare. They have to prepare their, that period should be kept as constant as possible. So they have to prepare accounts every year or every 15 months or every 18 months, like that. They should not like keep on changing between 1 year, 15 months, then next time they are like 18 months. They can't prepare accounts like that and all. That is like misleading. Okay, as the owners, investors, creditors, employees, and the government are interested in knowing the performance of the business unit periodically, it becomes necessary to select a particular period, normally 1 year, for measuring performance. Okay, so normally it's 1 year, but it can also be 15 months or 18 months. Hence, financial statements are prepared after every accounting period and not at the end of its life. Okay, so periodically you have to prepare the accounts. Okay, not at the end of the life. So that's about that concept. We'll move on to matching concept. See, according to this concept, revenues during an accounting period are matched with the expenses incurred during that period to earn the revenue during that period. Okay, so it works like this. You produced a car. Okay, you produced a car. All expenses incurred to produce that car should be recorded in the P&L, okay, of that year. You should not record it in the previous year or in the next year. Okay, this single car has been produced in the year, and every expenses regarding to that car should be recorded in that year only. Okay, so this concept is based on accrual concept and periodicity concept. Okay, so you are like preparing periodical uh, P&L and balance sheet. Okay, and it's also the accrual concept. When the cost is incurred, okay, that is what we have to take into account. It doesn't matter when you pay it actually. Okay, you, for example, uh, you, to produce a car, okay, you bought 4 tires, but that 4 tires you're not going to pay this year, you're going to pay next year. Okay, so should you record it this year or next year? The answer is you should record this year. Okay, it's an expense of this year because you produced a car this year, used the tire this year. Okay, payment alone you are going to make for the next year means that becomes a payable. Okay, or a creditor, he becomes a creditor. Pay him later, no problem, but the tire is used this year, right? So put it as the, you have to match it with this particular car and its expense of this year. Okay, so that's called as a accrual concept. So periodicity is about the year, and accrual, so all expenses paid during the period, okay, are not considered, but only the expenses relating to the accounting period are considered. It's not about whether you pay cash this year or next year, that doesn't matter. Okay, it's all about whether you are incurring that expense this year or next year. Okay, not about the payment. On the basis of this concept, adjustments are made for outstanding and prepaid expenses and accrued and unearned revenues. Okay, so this is a little bit tougher concept for you to understand now. Okay, but as and when we do a sum, you might get a idea. So what is realization concept here? According to the realization concept, any change in value of an asset is to be recorded only when the business realizes it. When assets are recorded historical value, any change in value is to be accounted only when it realizes. So we can put it like this. See, realization concept is, can also be applied to revenue. Okay, so you sell a good. Okay, you sell a good. When do you record it as a sale? When do you record it as a sale? Do you record it when you receive the cash? Do you record it when you dispatch the goods? Do you record it as revenue when the goods are still with you? Okay, and you have not received the payment, but just you have like transferred the ownership of the good. Okay, which is the concept. So we'll repeat it again. You have made a sale. Okay, when can you record it as a sale? Okay, is it at the when the cash is received, or the good is delivered, or the title or the ownership is transferred to the buyer? Okay, but still the good is with you, no payment is made. Okay, which is the concept? See, the concept here is the title. When the title of the good, okay, moves from your name to his name, he becomes the owner. So you can still hold the goods, you can still not receive the payment, but as he has accepted that it is his goods and he will pay later, he becomes the owner. Okay, so that is a realization concept here. So the next one is objective evidence concept. So objective evidence concept requires that all accounting transactions recorded should be based on objective evidence. So as we have already seen this in financial systems and procedures, okay, any transaction that has to be recorded in accounts should have a evidence, something like a bill, invoice, okay, or some kind of a proof, okay, some kind of a document. That should be an evidence. Without evidence we cannot record anything in a accounts. Okay, so you should have a receipt, invoice, and it is only based on the authenticity, accuracy and reliability of the transactions, okay, which leads to the trustability of the P&L and balance sheet. If your recording itself is wrong, then the P&L and balance sheet will obviously will be wrong only. Okay, so that's about objective evidence concept. So now we come to accrual concept. So accrual concept, like few slides before only we saw, accrual concept is it works like this. In accounts we don't consider like uh, we don't like think about the cash payment, okay, or the cash income that we are going to receive in this year. Okay, we are bothered about in this year what is the total expenses and incomes we are receiving, okay, in this year. Okay, we don't see. So you are, if you are making a credit sale, okay, if you are making a credit sale, okay, the credit sale is recorded in this year only, but the cash you will be receiving in the next year. Okay, so when should we record the transaction? Should we record the transaction as credit sales in this year, or in the year in which we are going to receive the cash, like it's the next year? Okay, the answer is, as per accrual concept, when you have made the sale, okay, when you have made the sale, that is the year in which you have to record. It's not about when you receive the cash or not. The same occurs in terms of payment also. So if you have bought some items this year, okay, for the purpose of manufacturing, it is this year's expense. If you are going to pay next year, or if you have already paid this expenses last year itself, that doesn't matter. You have incurred that expense for the benefit of this year, so you have to put it in this year only. This is called as the accrual concept. So understanding the logic would be like easy, but doing the sum is like little bit difficult. Okay, so only when we do it you can understand it. Okay, so revenue is recognized when it is earned, and expenses are recognized when they are incurred. All expenses and revenues related to the accounting period are to be considered irrespective of the fact that whether revenues are received in cash or not, and whether expenses are paid in cash or not. So that's about the concepts here. Now we'll move on to the accounting conventions.